Hello and welcome to a brand new show of Market Makers. The year 2016 is not off to a great start. Good old fears of slowdown in China and growth concerns in Eurozone are haunting us. Whereas global liquidity so far is stable, markets now worry about one more dimension, which is geopolitical problems in Middle East. The deflation fear is not over, but Indian macros are looking solid. So will 2016 be a breakout year for Indian markets, or Indian markets like 2015 will move in line with other emerging markets? What are the themes, sectors and ideas one should focus on, and what really could be the big breakout trend for this calendar year? Let's discuss all that and much more with Shiv Puri. He's back from Singapore and he joins us in our Mumbai studio. A very happy new year and thank you for joining us.
Thank you. Thank you for having me, Nikunj.
In the first couple of days of 2016, we've seen a lot of pain. Now, we've seen this pain in the past also, but frankly, nobody was prepared for this kind of an opening right at the beginning of the year.
Yeah, I think it's basically a fallout that is happening from the commodity bubble burst of 2014-15. And I think an important point to remember is that while China was the reason why a lot of the commodity businesses globally are suffering. This correction started about a year ago, and a lot of the hedges that the commodity companies had are rolling over now, which means that the stress that they will see this year, I think, can be particularly acute. So, I think the whole sector globally is going to have a lot of issues this year, and people are finally realizing that this whole price move back up is not going to happen in the near term. There have been trillions of dollars of capex that have been spent in the commodity sector globally, and this impacts companies, whether it's refining, oil and gas, metals, mining, agriculture, equipment going into those companies, services, the sovereign wealth funds. So the impact is quite large. It's global. And I think that that is going to result in a fallout this year.
Now, 2015 has been an eye-opener for global investors, which is that great macro does not translate into good micro and supermarket returns. On paper, India is the best market, both in terms of macro and in terms of growth. But some of that is not getting translated into real returns.
Yeah, so I think one of the things that I would say is that if you look at India in the context of other emerging markets over the last 2 years, the outperformance has been stupendous. Over the last 2 years, the equity markets have compounded at 12 or 13% in dollar terms, whereas most other emerging markets are down by that amount, annualized. If you look at what's happening in Brazil or Russia or China, so I think India is certainly out of the brick. You've taken the eye out, and it basically going through, in our view, a bit of a time correction, which I think is very healthy. A lot of the expectations in 2014 perhaps were pulled up front, and despite all the volatility that happened globally in all of the countries that I've just mentioned and all the other regions that we see, the performance last year was pretty good. So, I think that the relative position of India and the relative performance of India globally has been very good. What of course is not happening is we are not getting the domestic private investment cycle to pick up. That is going to take some time. There is concern. I think the biggest concern that exists for people in India would be the state of the banking system, the PSU bank specifically. I don't think there's any systemic issue there, but until that doesn't get cleaned up, new fresh lending into the growth sectors of the economy will be difficult to imagine, and that I think is the big bottleneck to growth going forward.
So let's look at all those aspects which you've raised one by one. First, let's talk about valuations. If my numbers are correct, Indian markets are trading at a historic premium to other emerging markets, and the premium now is more than 55 to 60%. So India is a great story, but prices are also great. Where is the headroom left now for Indian markets to go up?
So I think one thing is that one must look at these relative valuations in comparison to what we are looking at. A lot of the other emerging markets are very commodity heavy indices, whether you look at Brazil or Russia or some of the other emerging markets. So structurally, these are countries that have benefited over the last 7-8 years, from which we look at these relative comparisons with rising commodity prices. Whereas if we look at maybe perhaps the next few years, they are the ones that get hurt the maximum whereas India, on the other hand, benefits a lot from lowering commodity prices. So I don't think we should just necessarily look at the last 7-8 year comparison and see the premium that India has over them. It can sustain for a very long period of time. The second thing is the macro condition in India is also significantly better than any of these other emerging markets. So whether you look at the fiscal deficit, the current account deficit, so the macro has never looked better, in fact, I think for India as far as I can remember. You put all of that in place, and I think that the valuations are reasonable, but like we've talked about, there are certain segments where there is a lot of capital that's gone in where valuations are pretty high, and there are other segments that are completely ignored where there is potentially opportunity. So I think on average valuations are fine, and people are waiting for the growth in earnings to pick up.
Nobody seems to be assessing the impact of commodity crack on commodity producers. The Middle East countries, Brazil, Russia. Frankly, the durable source of cheap liquidity for global emerging markets has been sovereign funds, sovereign wealth. That's going to reverse. Saudi Arabia, they've cut their budgets by 14%. Infrastructure spend will go down by 45 to 50%. Sovereign funds were freely investing in real estate and emerging market assets. That's going to reverse because they need money back home to run their budget deficits.
I think that's true, and I think that is going to happen not only with them, but even with Norway and some of the other big pension funds. They've also announced that they are going to cut down on their equity allocations globally. But I think the important thing to realize is that sovereign wealth funds are not humongous players in the Indian equity market.
They're not?
They have not been so huge that if they were to all leave en masse, something would happen. I don't see that. I think in fact you have global investors that are here, but you also now of course have the domestic capital that's come into the market. This is a big fallout that's happened on the commodity bubble bursting, and I think this is going to stay with us for a while. But net, if you look at a few countries that benefit from it, I think India is going to be on the top of that list.
What's your take on earnings? So Indian economy is healing, Indian economy is coming back, but at least my sense is that valuations are here, earnings are here, and there is this transition which you have to catch up. It could be 3 months, it could be 6 months, it could be 12 months, it could be 18 months, and that is the painful period.
Yeah, I think what is happening in terms of earnings is that you're in an environment where your nominal growth is lower than your real growth.
Yes.
So
that's because of inflation data.
Because inflation is very low. So companies are struggling to show top line growth. That is the big issue. But I think what you see in 2016, one of the important things is that the whole benefit of lower commodity prices has yet to be filtered through the Indian economy. And I think that is one of the big positives that will happen in 2016. So any manufacturer today of a car, of really any equipment has yet to see the full benefit of that come in. And I don't see anybody cutting prices. So even if their cost of the metal or the rubber or the aluminum has gone down, I don't see them cutting prices. So you will see margins doing better in 2016, even on low top line growth. To get that higher top line growth, I think will still take a little bit of time. And some of that has to be driven by private investment.
Okay, if I take the clock back and let's take the tape backs, January 2015, the consensus call was buy banks, within banks, buy retail banks or buy private sector banks, and then load of pharma as much as you can. Banks have not given a fantastic return in the last 12-13 months, and pharma stocks have given a negative return anywhere between 15 to 30%. So I want to start with banks. If markets are confident of economic recovery, which is around the corner, why are banks getting a stepmotherly treatment?
So I think one is if you look at sort of the high quality private sector banks, they were up in the mid-teens last year in 2015, whereas the bank index was negative, largely driven by the decline in sort of the more commercial focused banks and the state-run banks. So I think the relative performance was pretty good. Now, if you look at it this year, I think there is going to be more of the same that will continue. Because
private banks will do better than PSU banks?
It seems that way still. Because I think if you look at what is happening on the state-run banks, there is a huge question mark of what exactly is the book value. And perhaps with the RBI governor sort of coming up with new norms on how he wants them to recognize this, there have been a lot of talk about sort of the stress accounts and how there should be uniformity in recognizing this I think over the next 6 to 9 months, there'll be a lot of clarity on what exactly is the book value of these state-run banks, because otherwise any sort of price to book multiple doesn't make sense when you don't know the book value. Until that doesn't happen, I still think that the opportunity remains in these private sector banks. At that point, one still has to assess whether, if the NPA issue is done, whether they have kept up in the changes that are happening on the technology in terms of management, which of those have kept up, which of them have fallen behind. So I don't think it'll still be a general sort of move even in that side. But I would really be still cautious on that size, that segment of the economy.
Now, HFC is something which we've discussed in the past, you've liked in the past, they continue to grow, yet the stock prices are stuck in a range. Agro Finance is off by about 100 rupees. Repco is off by about 15-17%. HDFC Bank, HDFC Limited also frankly has not had a great 2015. A good time to buy there?
So, without making any recommendation on these particular names you'd mentioned, I would say that, the housing finance companies have a structural opportunity that is probably there for the next 10 plus years. I think nothing has changed on that front. A lot of these companies had a great 2014. They went up a lot. So, sometimes you see companies front load, there's the performance.
So you are a buyer in HFCs, you're not a seller in HFCs.
I think these companies have a very, very long runway to growth.
Are you happy to own HFCs for 5 years?
I think it will probably even for longer. Because I think the structural growth that they have is going to be there. The only thing to be careful of in that front is that there is a lot of new players that are peripherally talking about entering the space. And some of them have set, top-down targets of what they want their loan books to be, which I think is a very dangerous way of going into a lending business. Because if you set a top-down target, that sets all sorts of wrong incentives, and the price usually you pay a few years later. So, that could disrupt the market for a certain period of time. Now, the high-quality HFCs have dealt with this before. They've seen this happen 5-6 years ago, and during that period, what they did is they slowed down growth because they don't want to get in lending in poor quality or compromising on rates. Now, if that happens, there is a potential that some of the multiples might correct. Barring that, I think the opportunity is structural for a long period of time.
The house is divided, or street is divided rather, on how should one view pharma stocks. There is a view which is that the US FDA problems are genuine. They are here to stay, and frankly every company which has got hit with US FDA problem, they've not come out of the black, whether it's a Wockhardt or a Sun Pharma. There is another thinking which says that these are cyclical problems, more like an election rhetoric. What are your thoughts? Is it time to buy into pharma?
You see, I think that in my view that this is a cyclical issue. It's not a structural issue. And it is, of course, very interesting that it happens during US election cycle.
Could it be a coincidence?
It's hard to see how it's such a coincidence. And if it was, why it's also happening in IT services. You're seeing IT services also having that protectionism sort of come in. So we've seen this happen 4 years ago as well, at least in IT services, and 8 years ago in pharma. So there is a pattern over here. Having said that, there are certainly the pharma companies that had fallen behind in keeping up with the rigorous standards that the FDA has. So they have been back there. Now, within that, I think it's important to distinguish those that have fallen behind a little bit and those where there have been some serious lapses. But I think for those that fallen back a little bit, that are trying to fix the issues that they have, this is a fantastic period. I mean, Warren Buffett says, right, you buy a great company in a period of temporary distress. And some of the great franchises that he's bought, the temporary distress has been much more severe than the distress that some of the pharma companies are seeing through the FDA issue.
So it's time to buy large cap pharma.
So I think that it's a very interesting opportunities exist in that space right now because it's a cyclical issue. And I think because these companies would fix it. And let's remember in the long term, once this election rhetoric is over, the US wants low-cost drugs. I mean, that is something that they, as a capitalist economy, and especially under Obamacare, that is something that they want. So this is not something that they're going to, stop all of a sudden.
Where are you taking chips off the table?
Yeah, so I think there is nothing broad-based that would require any of that. But I think one should pay attention to some of the areas where perhaps the valuations have gotten excessive, and the growth is yet to come. Okay. So, I mean, I think, one of the areas that people look at is certain pockets of capital goods. I look at that and I see, some of these valuations that are factoring in factored a turnaround in 2015. It didn't happen. They're factoring in 2016. We don't know. Yet in that same space, there are companies that are there in consumables and things like that, which are far more interesting and far more reasonably priced. So, I think one has to be a little sort of.
But are you fully invested in your India portfolio?
So, again, I think that the opportunity in India is still pretty attractive. And there's been a 1-year time correction that's happened. And I think if you look at the environment in 2016 and you do an assessment of what can be the downside versus what is the upside, I think the upside to downside ratio is very favorable for the market.
So what could be the downside?
I think it's hard to put an exact number on it, but even if you look at multiples of some of the leading franchise companies in the index mean reverting, you still sort of look at it and say that there doesn't seem to be more than that sort of a 10% downside in some of these companies. They can time correct for a period of time. But then as we've seen in years like 2014, the move up also happens very quickly.
A very well advertised sale in this market currently is in the commodity market. It's like a Flipkart sale. Everything is 30 to 40% cheap. It's time to hunt in commodities. You may not get the bottom, but the cycle eventually will reverse and stock prices have already reached historic lows.
Yeah, I think the one thing to look at a sector which has had a global burst is to wait for, in my experience, 2 things to happen. The first is that you have to start reading about global bankruptcies. There have to be companies that go out of business, and we haven't seen that happen. You've seen stock prices globally correct on commodity companies, but you really need to start seeing the pain of that before supply is being taken off. The second thing we usually see is a dramatic spike in the high yield and the energy index, in sort of the credit rating. Now, we've seen some of that happen, but usually when you associate a severe stress, those numbers are much higher. So it's hard to say whether that's right or not. And frankly, we
don't
look at anything in commodities. So, but in my opinion, that a lot of the companies here in India are actually big beneficiaries of this low commodity, and that works out quite fine.
Is it time to back urban consumption or rural consumption?
I think if we look at it today, rural consumption has yet to pick up because it's had a couple of years of bad monsoons. The subsidies have been a lot lower than before. But I don't think that any government in India can have a successful 5-year term by leaving the rural economy behind. So while we are seeing a modest pickup in urban consumption, I think over the next 3 years you are going to see a pickup in the rural economy happen.
So maybe it's time to buy some rural finance companies, some NBFCs there, maybe a two-wheeler company, because markets have sort of written an obituary for rural consumption. Everybody is still buying into the Jubilant Food Works and the PVRs of the world, but we're ignoring that India is still rural.
It is, and I think it's a very large market. And again, it's that period of temporary distress there. I don't think structurally the rural market has shrunk or the rural market is not there. It's had a couple of sort of one-time things. And I think if you have one good monsoons, the opportunity out there will suddenly, look very attractive.
Now, when you talk about HFCs, private banks, some pharma quality names, your clients would argue that, Shiv, these are very ordinary ideas. Every fund manager who's making presentation to us is also talking about these themes. What is your out-of-box idea? How are you planning to differentiate from other fund managers? So what was your answer?
So I think the response to that is that the out-of-box idea is that sometimes value is hidden in plain sight, and one doesn't need to be very creative on that front. There are certain themes that are happening in India which I think are very interesting here. They're happening in other parts of the world as well when we look at it, which is that globally any consumer of commodities is a beneficiary.
That's a country like India.
That's a country like India. That's companies within India. They're all beneficiaries. Healthcare companies in India or anywhere that have a low cost sort of setup that are selling into the developed world, I think is something that are going to continue to do well. Housing finance companies out here again are a structural issue regardless of what the growth rate is. The market share movement from poorly run state-run banks to private sector banks is something that's going to continue. So I think these are 4 or 5 things that are are fairly straightforward, but that's where the opportunity is. I don't think one needs to be too creative outside of that.
It's like saying India was a popular IT outsourcing destination in 1990s. It may be a crowded opinion, but that opinion really has made money.
It has. It's done very well. And
everyone is excited about couple of government sectors. Some fund managers like railways, others are betting on roads. Some fund managers are bought into defense stocks or defense companies directly, indirectly. Do you have any exposure to any of these beneficiaries or any of the companies which will benefit because of government spending?
So I think the government spending that is yet to happen in some of these areas is probably still a little too early in the areas that you mentioned, like defense. And it's very hard to, at this point, to figure out who the real beneficiaries of that are going to be. So in that sense, it's a little bit too early to just sort of have a bit of a view on it. I think even if a company that is making defense equipment is a beneficiary of it, you can also work one level below that and sort of see
the first derivative.
Who are the companies that are going to benefit, from that? So it may not necessarily be that their business relies on defense, but if that happens, that's an extra avenue of growth for them. I think at this point that might still be the better,
right.
Better option.
So 2015, I guess, has been a year of realization. Hope and hype got challenged, and a lot of money managers, a lot of market commentators, including me, we realized that it's time to bury in evidence, not hope. Will that be the story for 2016 as well? Don't ride the hope cycle, but bury in evidence.
I think that is exactly what 2016 was probably going to be about, and I think that's a very good thing. But we've also seen this happen in 2004, 5, and the early part of 2006. After that, everyone had a lot of hype and hope. So what can happen this year in 2016 is that markets will not give the benefit of doubt to the companies until the earnings don't actually come.
So earnings will come and then stock prices will go.
That very well could happen.
That could be a long haul.
That could happen over the next couple of quarters, and it may not be for the index as a whole, but specifically even for individual companies. Usually you would like to see the market is forward looking. It sees what's happening and discounts it today, but that may not be the case for 2016 as far as India is concerned.
You're not a table thumping bull for 2016, but.
No, I don't think there's table thumping or not. I'm optimistic on
double-digit returns is something one should expect.
I think that can be definitely a very plausible scenario, but it's hard to predict for 1 year. But I think that's a very plausible scenario. But I would look at it the other way around. I would look at it and say, where is the downside? That's the way to start. And
broadly, 35 to 40% return in 3 years. Is that something we should expect? Is that a reasonable assumption?
I think that would be very disappointing if it's even that.
So I'm bearish if I say that markets will give you 35% return in 3 years. That's a bearish baseline assumption.
That's like a 10% compounded sort of return, which I think is not very attractive for.
When we started there, 2015, who thought cash would give the best returns? 2015, cash has given the best returns. Yeah,
but that's only for a very short period of time. If I take it back to 24 months, then
So this year belongs to equities?
I think so. I think that if we look at it again, if you look at what are the options in India, right? You have real estate. That I don't think is a great asset class to be in. Neither does gold seem to be a great asset class to be in. If you look at fixed income, yes, there is some opportunity out there as rates come down. But I think the moment the investment cycle here in India picks up, equities will still be a very attractive class.
And Indians have discovered their hunger for equities, and IPO markets are throbbing. Really appreciate your time. Good luck for 2016 and hope to see more of you.
Thank you, Nikunj.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.